Hi, let's talk about NetApp that provides software, system and services to manage and share data on premises and private and public clouds worldwide. The market cap of this company is pretty big compared to what I usually research, 17.2 billion. It's currently trading at 20% below the site's estimated fair valuation. Also, earnings are forecasted to grow over 16% per year, but there's also a risk that every investor should count. Has high level of depth, unstable dividend track record. I think they cut this year or last year. We'll be back to that. Profit margin is lower than the last year's, so 10 years currently, last year's 18. The stock price met pretty well this year. There was some of the depth financing, product updates, and strategic alliance with the newest report. Data Stacks collaborates with NetApp, which is pretty good. And anyway, market performance shows that 1 year return 73%, beats the industry, beats the market. Long-term price volatility a little bit higher than the industries, and in 3-year frame, for example, here's the interesting thing: the company returns 11%, but the industry itself returns 146%. So this is one of the things that I will be making in a future video. Is there I would compare which was better to invest. Either you pick stocks by fundamental analyze, or whenever you buy the fund with lower cost. But we'll back to it. 5-year frame 200%, and industry itself beats the company's return. So usually the industry, or especially, for example, if we take S&P 500, usually it returns way better than if an average investor picking the stock. So mostly, if your risk-taking abilities allows you to not enter those highly volatile shares, probably there's more to be better thinking of the fund that is investing in sector or an S&P 500, and it's better to be low cost, because otherwise you pay too much commissions and costs. On the valuation side, so based on simple Wall Street, fair valuation should be around $97 per share, and if we look, 97 simple Wall Street, simple tip rank shows 96, in good scenarios even $100 per share, which made currently upside 24%, and I think similar numbers have MarketWatch. Actually a little bit higher average, an average 77. So based on MarketWatch, this stock is reasonable valuated, and stock in good scenarios same as the tip rank 100, median 78. So based on MarketWatch, the stock is pretty good. And if we show the FinVis, the stock price went pretty good this year and the last year. So there's you see long-term upside trend, which is pretty good, and it's moving in those lines. So there's the two lines, upper line and downer line, and it's pumping up and down in this tunnel. Simple Wall Street shows that future growth is forecasted 16%. The annual earning growth and earnings per share growth is forecasted as well as to grow, but currently it's look like it's declining. to the EPS, actual 2.6. So they are profitable, but it's going down, and that might a little bit put pressure on investors. Are there something on? Past performance 23%. That is the historical annual earning growth. They had also the ups and downs. Currently, I think it's recovering. Yeah, it do has high quality earnings. In financial health side, let's look. This is not so good because, yeah, as you can see, dynamic shows that equity is decreasing. The depth level increased. Okay, this makes sense. They do have a cash, almost 4 billion. That is very good, but yeah, the good thing is that the cash level is covering depth, so this is not so bad as I expected. Anyway, debt to equity ratio is 550%, which is very high, but luckily they don't have negative shareholder equity, which would be more serious. And by Snowflake, you see here that it's on the orange line, or more to yellow, so it's better than the stocks I research usually. Dividends, so currently dividend yield is 2.48, and if we check, for example, simple save dividends, do they have, yeah, so last 5 years were very fast. Yeah, actually they have April last month they paid $0.48 per share. 2.48% is current dividend yield, and stability and growth of payments. Yeah, the dividend yield raising to the, yeah, even in 4.5 in February last year, but yeah, currently is around 2.5%. And yeah, as the company pays dividends, there's this parameter should be included, current payout to shareholders. So they paid 72% paid as dividend from the earnings. This is not significant, and anyway, the future payout is forecasted to be 40% will be paid as dividends from the earnings in the 2024. And ownership or any insider transactions, yeah, actually there's two individuals that brought at good price, by the way, $61 per share and $63 per share last December and this March. Okay, ownership breakdown. Institutions 93%, general public 6.5%, individual insiders 0.2%, state of government 0.04%. Top shareholders, BlackRock increased. Do we have, see here, the Vanguard? No, I don't see Vanguard, but there's many of them increased the stock to their portfolio. Wellington Management 44,600%, hugely. But there's on both side actually. For example, biggest shareholders have been decreasing. Last reporting holding day 31st of March. And simple save dividends shows that earnings per share is growing. Shares us. This is actually, when you see this kind of parameter, it means pretty good company based on shares outstanding. So they're decreasing. They're buying back their stock from the market, which made pretty. If we see here, for example, 1 year return or even 5 years. So with buybacks, it's better. It's better with buybacks. But there's companies with buybacks and dividends. So mostly, if you see some of the growth companies, they usually prefer only to decrease their stocks from the market. So shares outstanding decreasing, total sales also decreased since the few years, for example back 2019, 6 billion and currently 5.59. Anyway, this is volatile. So 3 years ago, 21st of September, for example, bro, held it 2 years. Okay, this is back to the September. Yeah, so this is actually the thing that I've been trying to make video of. There you have the example. 2 years you've been holding it. You have minus 50% of capital. Okay, then it grew back and it didn't even get more than you paid back, for example, back in 2018. And yeah, so this is actually a thing that every investor should think, because if you buy the whole sector, for example, if we go back to the FinVs, so if you buy the whole sector, it doesn't even matter then which company makes better returns. So mostly if your risk-taking abilities allows you or doesn't allow you to invest so the highly volatile shares, or then it's better to buy fund, low-cost fund. And as you can see, there's an ups and downs, and there could be, for example, this time going on, February 2011, where you could hold the stock even 7 years. So be careful, guys, on the market. Don't invest more than 1% of your portfolio, and try to avoid the pump and dump stocks or highly volatile shares. But if your risk-taking abilities allows you, invest like no more than 1% of your portfolio. Anyways, investing.com, starting with the stock for long-term investors, is a strong buy. Thanks for watching this video. Subscribe to the channel, like the video, and see you in the future one.